All right, so welcome to our Business Builder webinar on 4 numbers that drive your business. Many of you have been with us before, and we've talked about this growth ladder, which I'll mention in a second. I'm just going to make sure Peter is on with us and you can hear him. Peter, you with us?
Welcome, Karen. Nice to be with you, everyone, today.
There he is. Thanks. Peter's joining us from the States. As you know, we often have guest speakers who are from all over the world. So wherever your business is, UK, Europe, America, Canada, Australia, whatever, you're very welcome. And Peter's going to be chatting on a few of these 4 numbers. But just as a quick summary, as the kind of point of these webinars that your accountant has invited you to, is to move you through from foundational issues to having the freedom to do what you want to do in your life and business. And this one today is very much a foundational issue. I presume you agree with this, Peter, that it's very foundational to know these key numbers for your business.
Absolutely. In the over 30 years that I've done, transitions and turnarounds, without a question of all the disciplines in running a business, the weakest is always fiscal management. So yeah, the numbers play a very big role.
Excellent. And I'm sure your accountant would agree, which is why they've asked us to present on this and to get Peter to speak on this, because you can have all the numbers there, but it's what you do with it that's really powerful for you in your business. So we want to help you with that. We know your time is really limited, and we really appreciate you taking the time to join us. We've muted everything on your end so that you can just have your cup of coffee or wander around or answer a phone call if you have to. But if you do have questions, you can type them into the chat function, and we'll get in touch with you on those. But let's look at these 4 numbers. This is Peter sitting with a lion, I think. Do you want to tell us about this photo, Peter? Brooke says it's your favorite.
We were at XeroCon in Sydney last summer, and we're going to be out there again this summer. But we went through one of the beautiful gardens over there, and my beautiful bride snapped this picture. And I was just excited about the fact that we've become a global business now, and Sydney's an incredible place. And if you ever get a chance to visit there, you should. But that's where it came out of.
I agree entirely. Love Sydney. That's great. Do you want to give us any, I know you're with MyProfitSee, but do you want to give us any background on just your background on the number stuff, or do you want to sprinkle that throughout the...
No, just because I don't like talking about myself, but it might give a little bit of a foundation if we could. My undergraduate work was long ago. Dirt was young. I was a math and programmer, math major, and a computer programming person, so I did Fortran. I actually was one of 5 students asked to test a revolutionary new programming called BASIC, and I was a spreadsheet freak. For those of you who know where the spreadsheets originally came from, the very first one was called VisitCalc. It preceded Lotus 1-2-3. And I laugh about it because I was one of 12 people that kept breaking it. It didn't have enough rows and columns in it for the algorithms. So in the 80s, I began helping very, very large multinational Fortune 70 corporations in changes, in turnarounds, and transitions. And I got a little tired of helping the big guys. So in 1991, I started helping small and mid-sized businesses. And it's been a delight. I've written 2 books. I'm contributing editor to 6 different financial journals in the United States over the years, a lot of platform speaking. But 6.5 years ago, we launched MyProfitSee, which is essentially cloud-based accounting software. It's fully integrated with Xero that provides your accountants the kind of tools and analytics for helping your businesses. So we work primarily with people in accountancy, and that's kind of where it came out of. I like fixing broken things, but particularly businesses that are going through challenges.
Excellent. Thanks. And as Peter says, he even mentioned to me that it's less important where he's from and more important what he's helping you look at. But as he said, if your accountant currently uses it or can use it, they're certainly welcome to. But the key is for you to know the numbers for your business, and no matter where your data is, whether it is on a spreadsheet or it's on an online software somewhere, whatever, it's a matter of pulling it together in a way that makes sense to you. And so we want to talk to you about four numbers that we've picked out that are really critical for your business, based on my experience and Peter's in working with small businesses over the years. And if you don't know what these numbers are, is really important to find out. We do have a few of these little bright idea tips that pop up throughout. Those are intended to give you an action that you can take right away. And that's the goal that we would love to see you achieve, is to actually do something with it and not just go, oh, okay, that's really helpful information, and then go on your merry way, but to know what the numbers are and then be able to see those improve in whatever way that is. So I'm going to let Peter just, I think the way we're going to do this is just Peter and I are going to chit-chat about both of these things, but I'm going to let Peter kind of take the lead, and then I'll jump in if I have something to comment. So if you want to, do you want to give an overview on these four, Peter, or do you want to just jump right in?
Absolutely.
Okay.
I don't say it's misleading to say there are only four numbers, but let's say there are four key analytics that play a huge role in understanding the dynamics of running your business. And it's important to understand how they are, because most business owners, particularly in the small and mid-sized business market, you all have very unique skills and talents, and it's the reason your companies are in business and have not only persevered and survived, but hopefully prospering despite whatever the economic conditions are at any given time. But it's important to understand that there are some actual disciplines involved in looking at what's going on. So the first one is, what's our conversion rate? And what this essentially means is, who are your actual target market opportunities? Are you business to business? Are you business to consumer? How long does it take to close a sale? How many opportunities do you have? How many of those actually wind up with a sale? Are the sales recurring? Are they one time? So that's called conversion rates, and if you don't have a clear picture of them, you really don't know how to fill the pipeline. The second piece is, there's a critical element in your financials which is called break-even. And that's the actual revenue nut you have to hit in order to pay the bills and make sure you can sustain the company. Now, I've seen a lot of ways of looking at break-even, but I actually trademarked a slightly different way of looking at it called true break-even, which I think is a much more realistic approach for understanding what it costs to operate the business. But more importantly, it's going to tell you how modest amounts of revenue can actually multiply profitability. Once you hit true break-even, very modest amounts of revenue can have a huge impact in terms of profitability. So that's an important one. Net profit margin, this is knowing, really what you're making through the operation of the business. And it's the reason you want to work with your accountant, because it's their objective to help you shelter taxes, and how do you distribute those things. And then finally, how do you benchmark growth? So for example, one of the things that we offer your accountants through our software is the ability to use the kind of tools that are done by multinationals, by analysts and CFOs, for actually doing risk and cash and capital needs to benchmark growth against others and peers in your industry. So you want to always be in the top of the bell curve, not in the middle, not in the lower part of the bell curve on the benchmarking. So those are the four key things. There are lots more numbers, and they can be confusing. But I think if we get this kind of foundational basis, then you don't have to worry about the 23 KPIs, key performance indicators, and all those things. There are certain things that are good to know, but I think these are the foundations. So there are numbers behind these numbers.
Yeah. We've stuck this in here just to mention that if you've got all the data, which we're saying like the numbers behind each one of these numbers, like in order to know your conversion rate, you have to know things like how many customers or clients you have and how long they take to purchase, and we'll talk about that. But whether it's zero or something else, I mean, not bound to that one, but something that's going to help you put all your data in one place so that you can then generate this stuff. That's a really important thing. So
yeah,
I want to
Right. I want to comment on this. One of the things that's really elegant about how Zero works is that because it's in the cloud, your data, your numbers are real time. And one of the challenges I've seen historically is that if the numbers are not real time, if people are only posting information every so often, or they're able to run some of these number reports, but they can't do it until the month is over and the bank checks reconcile, you'll be seeing things that you need to work on, but it happened 5 weeks ago or 6 weeks ago.
Yeah.
And one of the things that's really elegant about using cloud-based accounting software like Xero is that it provides the information in real time. Our tools do it in real time. And so it's a way of knowing what's going on so that you can fix or celebrate, depending on what you find out, as it's happening. Very, very important place.
Couldn't agree more, and I think that's one of the things that small businesses have discovered. I mean, obviously cloud accounting and cloud anything is hardly new, but that principle that you don't have to wait till the end of the year or the end of the month even. You can check these things right away. And as we start talking about these 4 numbers, we're going to move to conversion rate in a minute. You want to bear in mind that for some businesses, depending on the kind of business you have, you may need to check this daily or even hourly.
Yes.
Is that fair to say, Peter?
Yeah, absolutely. I know we've actually done some special projects on some businesses that have a high amount of transactional sales, where we're actually monitoring weekly sales projections, sales performance, revenue collection, and it's between both the salesperson and the sales manager, the principal of the company. So yeah, these things become very, very important in terms of managing the activity of the business.
Excellent. All right, so let's look at conversion rate for starters. And I know we talked about how there's numbers that you've got to know in order to calculate this conversion rate. You don't just, log into Xero or pull up your spreadsheet and there's conversion rate sitting there. So if you want to talk towards these, Peter, about what you need to know about these.
Yeah, I think the first thing you have to take a look at is how many new clients do I hope the company can generate in the next year? Now, again, if you're retail, maybe you're not so much interested in tracking new clients, but you're interested in knowing how much traffic is coming through the business. Are there patterns to the traffic? In terms of how many people come into the shop, if it's retail, what's the average purchase? How many of them leave without purchasing anything? If you're in more of a service-based business, let's say you're into investment, financial services, maybe you're only looking for 6 or 8 new clients in a year, but you know that the time spent to gather 6 clients and actually capture their investments and wait the 4 to 6 months before you see income in this might require 20 prospects or 30 prospects. All these elements really play into managing the opportunity of the business. One of the largest challenges, I think, for the small and mid-sized business market is they get busy being busy. And so the company is kind of running itself, and it's not being proactively managed. So from our side, understanding not only who your target audience is, who your market is, whether it's a business-to-business sale or a business-to-consumer sale, it's important to know how many of them you need to create in order to know how many of them you will actually convert. So Karen, I know you guys work with this a lot. Your thoughts on this?
Yeah, I think as mentioned here on this little bright idea tip, it's really critical to know, as you were saying, for your company, and this is going to be different for everybody, how long things take, because you can have the numbers on how many prospective customers or clients you have, how many of them converted, what your rate is, but you could get discouraged saying, my goodness, our conversion rate was really low this month or whatever. So you want to look at it on the scale that relates to your business. If you're in professional services, then oftentimes the lead time is a lot longer because people want to be educated. They want to trust you. They want to know that you know what you're talking about. If you're selling a product or an app or something, then your conversion rate might be super fast. You might send out an email and get 400 people downloading the app. So it's, once you know these numbers, it's also important to interpret them in a way that is right. Now we'll get to benchmarking later, but I think that's a valid point to think about, and it's really helpful for your own marketing in the future and for getting more clients if you understand that, because it either means that you won't put pressure on people and stress them out and lose customers that way, or it means you will put pressure on at the right time and you will get more customers that way.
You know, Karen, I think there's an important element in this too that people sometimes neglect, and that is the whole idea of a sale means you've established enough trust in the relationship that they want to move ahead. And so, I mean, in different industries, different things create trust. My wife is an estate and financial planner and an attorney who works specifically with physicians and surgeons for tax and estate planning. And of course, here in the United States with the Obamacare thing, a lot of them are very, very afraid. But what she found was to establish a high enough level of trust with them that they were actually bringing her referrals. Took about 2 years. It took 2 years of a really good relationship in order to establish new leads and prospects that came naturally out of her target audience. Now think of how that's different with a restaurant. You know, with a restaurant, there's an initial impression when you walk in. There's how you're greeted. Is the maitre d' really wonderful? Is the wait staff good? How good was the food? Did you have an incredible experience? And then you'll tell others. So there are all kinds of different elements that play into the lead and prospect thing. But I do believe what your partner, your client experience is, has a huge impact on this ratio. And so it's not enough just to say, here's my ratio. And it's not enough to say, here's what the industry standard ratio is, right?
Yeah.
But it's important to understand what drives the ratio. So I know we're bringing up this slide on the conversion rate, but basically what you have to understand about your conversion rate is if you have 85 leads and out of that you generate 14 new customers in some given period of time, then your conversion rate is 16%. The thing you have to ask yourself is, what's the time frame on that conversion rate? And of those approximately 71 leads that didn't convert, is there something else that could increase that ratio? So,
yeah, and also the concept of time, whereas your conversion rate, say you measured this over a period of a month and your conversion rate looked like it was 16. But for those same 85, if you measured it over 6 months, what if your conversion rate went up to 50% because it takes them 6 months to agree? So you want to look at those things, and as I say, don't get discouraged by a low number. And also look at your marketing to understand whether you're going after the right kind of people. Because if you're going out and people are inquiring, but they're not your kind of customer and you don't want them anyway, that's a win.
Yes. Yeah, don't ever get desperate that you're basically hunting for crumbs and taking on people that you'd rather not do business with.
Oh, yes.
They will create 80% of your problems.
I think we could run a whole webinar on that. Yeah. And we probably have. We've run a good number of them, but I would definitely agree with Peter on that one. Is just, if you start taking anybody, it will bite you later on.
This element here is a really important one, which is dormant customers, you know, and they haven't purchased in over 6 months. We did an analysis about 15 years ago on how many touches does it take with an A customer, an A client, to keep them active with the organization. And this was really interesting. Now, what does a touch mean? It's like, it's an email, it's a thank you note, it's an invitation to something. There's all kinds of ways. It's a telephone call. We had one business that the owner on their client's birthday would call them to sing them happy birthday. Now the owner, true, and the owner couldn't carry a tune in a bucket. And he didn't care if he had got them live or not, it would be on their voicemail. But it was phenomenal because the relationship was so strong. And here's what we found. With an A customer, it took 20 to 24 touches a year to keep them from being dormant. So it's not just enough to look at the number. You have to look and say what's driving the number. So
yeah. And it's important to know, you know, every business is, you're going to have a lot of differences here. I worked with a printing company here in the UK who often were looking at their dormant customers, because with printing and stationery and office supply, it was, you know, it's the kind of thing that you order for a while and then maybe it goes off the radar, and then maybe you get a leaflet in from somebody else and you try them. And they discovered they could have a whole marketing campaign around the customers who hadn't purchased at a certain time. There was like a point at which the system would go, bing, you should probably contact these people because it's been too long. So there's a lot of other numbers that you could start looking at. So you may want to look at your numbers to see if you can record what is that perfect point at which, if you don't catch them then, they may become dormant and stay dormant and go beyond dormant and become dead, you know, and
exactly.
they never buy from you again.
And hence why we take an approach that says touches. How do we do that? So.
Yeah, exactly. And I would even say, you know, as we go along with more and more and more things being done online, the touches, number of touches needed increases all the time, because you could have a tweet and then a Skype message and an email and
Absolutely.
a leaflet comes in. I mean, there's hundreds of things. So
there are lots
anyway.
in today's marketplace. There are lots of ways to create these touches.
Yes.
So yeah.
And it benefits you massively if somebody gets an email from you and then before your next email they've got 5 or 6 touches that you didn't even know about. Things like a tweet coming through or a video being posted or whatever.
Right.
So you want that to happen.
Absolutely.
But let's look at break-even.
Oh, we've come to my favorite topic.
This is Peter's favorite area.
I'm gonna preface this by saying, with accountants, there's it's called Generally Accepted Accounting Principles, GAAP, GAAP. And if you try and live by GAAP, you'll die. Now let me show you how crazy things are in GAAP. Okay. For example, your accounting software will print out a profit and loss statement. Did you know that your profit and loss statement doesn't tell you whether you're making money or not? What? No, it really doesn't. Well, why could I say that? Let's say your accounting software is being based on accrual. In other words, accrual means if a bill comes in, it assumes I've paid it. If an invoice is posted for a customer, it's assuming they've paid it. But we all know sometimes we're not paid on time, so there's aging receivables and aging payables. Okay, so let's say we don't do it. We keep it on cash. Well, surely that would tell me on a cash basis, is this true? It's also not true. Let's say your business has a loan. Okay, so your business has a loan, and in your profit and loss statement, the interest on that loan is accounted for because it's an operating expense. But the principal on the loan does not appear in your P&L statement. It appears in the balance sheet. And it doesn't even say loan payment. What it says is there's a liability, because the principal on your loan is a liability. And it basically, every month, that liability shrinks.
We're losing you a little bit, Peter. I'm not sure if it's...
Audio mean?
Let's just check in here.
Okay, tell me when I'm live again here.
Do you want to turn off your webcam, Peter? Maybe that's affecting it a little bit.
Sure, happy to do that.
Okay. Not that we can even see you, but the system says it's on. All right.
Okay. Is that better?
Sometimes maybe this is like a bizarre system thing that enables me to pipe in, but I've noticed this before. If the guest speaker is chatting away and I'm staying silent, then the volume can disappear. So it's a built-in thing that makes it so you have to hear from me. I'm sorry. I apologize for that.
No. That just told you that you and I both need to get fiber optics for our internet.
Well, that is true. That is true.
Okay, so anyway, to get back to the fact that your P&L statement doesn't really even tell you if there's a profit and loss, the principal payment on a loan doesn't even appear on the P&L. It's hidden in the balance sheet. Aging receivables. How about you know, many of you would rather not pay your taxes until you absolutely have to. So a lot of business owners, for their own wages, their own income, don't put themselves on payroll. They borrow, quote, borrow money from the company in order to pay themselves, and then your accountant reconciles that at the end of the tax year. Well, the money that you're paying yourself does not appear on the P&L statement. Instead, it appears in the balance sheet as an asset. Think of that, not even as an expense. It appears as an asset because the company says, from an accounting standpoint, we've loaned money to somewhere, it's going to get paid back to us. So, you know, break even is a very tricky thing to do. Now, traditionally, the equation for break even is when revenue equals expenses plus tax plus depreciation. So what is depreciation? Depreciation is how much you get to write off hard assets. It might be your furniture. If you own the building, there might be a depreciation factor on the building. Computers, though most of them tend to be written off 100% in the first year as an expense. But there's all these things that are in depreciation. And business owners tend not to think of depreciation as a real expense. But they are. I mean, we own our office building, and every year I spend so much on fixing the air conditioning, getting rid of ants. I mean, there's things that happen that are real expenses within that. So you have depreciation as a hard expense. Now, unfortunately, this is not a real representation of what your true break-even is. And so, Karen, if you'd go to the next slide here. So what really is true break-even? You weren't here just to really break even. I love the slide about breaking the rules.
Oh, here, I'll go back to that one.
Yeah, I love that slide because you're here to think outside of generally accepted principles. You're here to break rules. You're here to build your vision. You're here to fulfill the dream of why you went into creating a company, why you're running the company. And it's very, very important to never lose sight of that as a vision. But it's also important to understand what your true break-even is, because there's some mystery numbers that come alongside of that. So if we move ahead now, we'll get into kind of the more fun stuff of this.
Yeah, and just to add as well, I skipped this one a second ago, but I think from my experience, and I'm sure Peter's the same,
yes,
there's a lot of companies who either hover on the one or the other side of the break-even. So
yes,
if you're not actually making enough to pay yourself and pay your employees and pay for the things you need to pay, you are, you know, funding your own business. You are just pulling from wherever this money is coming from, it's yours. And we see a lot of business owners who do this, and granted, it's totally fine to do that for a period of time. But the reason it's so critical to look at this number is because if you don't exactly know down to the penny what this number is, then you can get into a bad habit of going, it'll get better next month, it'll get better next month, and meanwhile you're essentially having a very, very, very poorly paid job that requires you to work 24 hours a day and doesn't give you anything else.
We call that, yeah, we call that self-employed with helpers.
Yeah, yeah, exactly. And the thing is, you know, we've talked about this before, that oftentimes the reason you went into business, you want to be your own boss, you want to have freedom, etc., etc. But the reason we're talking about these numbers is because if you can have them right for your business, then you will be able to have all those things. And I like Peter's point that there's the break even, and I'm doing quotes with my hands, but you can't see them. But there's the break even that you think your business should have, where I got in enough money that I could pay the things I need to pay. And what Peter's going to talk about is what he calls the true break-even, which goes well beyond that. So I'm going to let him talk to that.
Super. Here's how I define true break-even. It's when revenue is equal to your fixed expenses, all the things you have to pay every month, your cost of goods, cost of sales, so that's like sales commission, and if you're selling product, and you know the cost of that, plus your taxes, plus your depreciation, plus very few companies actually have positive cash flow 12 months out of the year. And so you have to have something, if your receivables aren't coming in fast enough, or if your company has some seasonality and you know that in August and September the revenues are going to go down and then they go up again in October, you have to be able to pay the bills on those down months. Now, for many, many years, the banks always helped the business sector through lines of credit. And because of what's happened in the global economy in the past 6 years, the banks have become very, very difficult to get these kind of lines of credits out of. And frankly, the businesses that can get them don't need them. So it's important for you to understand from your history how much you need in cash reserves. Now, there's another piece that comes in, which if a company is not growing, it's basically dying. There is no static business. Whether your growth objective for the year is 2% or whether it's 30%, whatever it might be, the one thing that's for certain in a business is you have to spend money to make money. And so you have to know how much in your business strategy you're going to be reinvesting for growth. Now, it might be additional employees. It might be that you've decided you're going to open up a branch office in Bristol. It could be any number of things. But you have to know how much you need in terms of growth. And then the last element, to me, is risk. Now, what do I mean by risk? Sometimes interesting things happen, not by you, not because of you, but they just happen. Maybe a competitor who looked to be doing well went bankrupt. Maybe they went out of business. And all of a sudden, all of their client business prospect opportunities become available to you. Do you have enough opportunity money, I call it risk money, to say, I'm going to go after that opportunity? Many, many things happen that we're unaware of. But when they happen, they become obvious to us. And unfortunately, most business owners are going, I can't do anything, because you don't have the working capital for going after it. So I want to talk about what this means. When I talk about true break-even, I want to know what my true break-even is in a monthly basis. Now, obviously, cash reserves don't happen every month. But I know that if I'm going to save for cash reserves, I need to put some of that cash aside every month. So in other words, the revenue piece, let's say I know I needed 50,000 pounds for cash reserves in my company. And I'm going to take a 10-month basis for building that. So that means I would have to set aside an additional 4,000 pounds a month, keep it in, hopefully, an interest-bearing account at the bank in order to manage those 2 months where we go upside down 25,000 pounds. It's just proactively managing the capital of your business. How do you discover it? You discover it by going historically and saying, how far are we upside down? How do we manage that? Oh my God, I took it out of my own wallet. Okay, so cash reserves, it requires a little proactive planning. Now growth is the same thing. Okay, if we're going to go to Bristol, then how many employees will I need? What's an office space going to cost me? How long, what's the sales target there? How long will it take to get to that sales target? At what point does it break even? At what point does it pay for itself? At what point does it make money? Now, in big companies, they do that through Boolean algebra and spreadsheets. It's really sophisticated stuff. The average business doesn't have access to that. So, usually what happens is the owner holds up their thumb and makes a guess, and off we go. One of the tools that we provide to your accountants through MyProfitSee are very, very sophisticated tools like that that are used by multinational corporations to help understand your growth opportunities. And then risk, how do you measure risk? Well, I don't know. It's kind of like, what are you willing to have set aside? Is it 5,000 pounds? Is it 12,000 pounds? It's some number that the owner says, no, this is fine. Now, what's nice about growth money and risk money is we're accounting for it as an expense. If you don't spend the risk money, guess what? That's net pre-tax profit at the end of the year. Now, there'll be tax implications on it, but it becomes a way of really, really measuring what's going on so that you know, by paying myself so much, what is my real target in revenue. Now, there's a magic number that comes out of this. I used to give a workshop on this called Tripling Your Profits. And people would say, tripling my profits, how would I do that? And I say, well, for most businesses, a 15 or 20% increase in revenue in a year would probably triple their profits. What? How could that be? Well, here's why. If you look at the equation of true break even, do you pay fixed expenses twice in a month? What do you think? Do you? Of course not. Once you've got the cost of depreciation figured in, do you pay that over? No, you don't. Now, taxes are a variable. As you make more, you'll pay more. Cost of goods sold, cost of services, they move, absolutely. Your cash reserves are fixed. Your growth money is fixed, and your risk money is fixed. So if I take the addition of my fixed expenses plus depreciation plus growth and plus risk, and I say what percentage of that is that of revenue? And just to keep it simple, let's say that those combination of expenses that don't move are 50% of my true break-even. That means every 100 pounds of revenue I do above true break-even results in 50 pounds of net pre-tax profit. This becomes a very, very amazing magic formula because my true break-even now has told me where I really need to be financially stable. And now I know how to move ahead with generating top-line revenue. And I'm knowing, before I even go out and do it, that it's going to create massive increases in profitability. And the reason is that I've understood my true break-even. The objective of true break-even is not just to say, how much is it costing me to survive? It's saying, what is my opportunity for significantly increasing profitability? And that's why the money for growth and the money for risk and the cash reserves is so critical, because that's the capital that's being utilized to stable our life and to build that additional revenue above true break-even.
I think what's interesting too is that a lot of business owners would consider the true break-even to be like cash flow analysis, which is something extra that you do later, and meanwhile I'll just worry if I'm breaking even. But I think your point is a really good one, that it just having some money come in, especially this point about growth and risk, because you have to know, everybody knows what you're willing to risk for the business. It's just you maybe haven't defined it. You maybe haven't put a number to it. But if somebody pressed me, I could certainly tell you mine.
Yeah, but you haven't put the money aside for it either.
Yeah.
I mean, to me, the idea is when the revenue comes in, that what I've targeted for the month in cash reserves, growth, and risk, that's going into an interest-earning bank account.
Yeah.
Now, it doesn't mean I'm not going to use it, but it's there for me.
Mm-hmm.
And so it's a different way of framing it. Instead of saying, oh my goodness, I've got to pay for growth, let me haul out my wallet and take it out of my own paycheck. So again, it's a magic number. And to be really frank about this, what we have found in a lot of service-based businesses, the fixed, that magic percentage tends to be above 70%. How would you like to make 70% of every piece of income above true break-even? Anybody would. But now you understand why it's there, and you've built a foundation for stabilizing the company economically, financially.
Excellent.
Now,
we've got a few things here that we've just put in terms of increasing profits, if you want to talk to those.
I do, because this is kind of the magic element that comes along with true break-even. There are only three ways in a business to increase profits. I can increase the revenue faster than expenses, right? We've all heard the saying, yeah, I'm losing 1 cent on every pound that comes in, but don't worry, we'll make it up in volume. You know, you have to increase the revenue faster than expenses. That's one way of doing it. The second way of doing it is you can decrease costs. If I can take, if I can get the product or the materials cheaper before we assemble them in the plant, but I can sell the product for the same thing, good. Or maybe I can decrease cost in the operational side of the company, the fixed, it's wonderful because that increases profitability. But the best way to do it is by increasing efficiency. In order to get more done in the same time period, that's the fastest way to increase efficiency. Because if I can increase the efficiency of the operational side of the company, say by 4, 5, 6%, that's phenomenal because it's saving me time, labor, money. It's speeding the delivery of products and services, which means my cash flow is faster. But these are the only ways to increase profits. Now, here's what's the magic behind this, and if you go to the next slide, that would be good, is the only commonality, the common denominator in all of it, are the people that work for you. Because you can't increase revenues faster than expenses if your salespeople and your customer support and service people aren't making it happen. You certainly can't decrease costs if the people who are actually spending money for paper, the office supplies, all the things that go into the operational side. And you certainly aren't going to increase efficiency if it isn't understood and bought into by employees. So the common denominator increasing profitability is employees. So what's magical about this? And again, we go to the next slide here.
Is that the right one?
It is, yeah.
Okay.
To me, what's magical about this is the way bonuses and incentives are built in most small businesses are wrong. They're just done the wrong way. So frequently, employees are rewarded if revenues increase. Oh, good, revenues increase, we're going to increase the bonuses. Another one I've seen a lot is arbitrary awards. Sally has done such a phenomenal job, I'm going to give her the big bonus because this wouldn't have happened without her. Or another one, which is a bugaboo of mine, is we have a certain pool for profitability that is allocated to bonuses and incentives. And so we look at what their wage and salary level is, and then we allocate it based on wage and salary level. And every one of those ways is a wrong way because none of those incentives have anything to do with the 3 ways that we increase profitability. There is not one single element in there that says those things are going to drive my team to improve profitability. So there is a right way. And if we go to the next slide, we'll talk about it. If you understand profits above true break-even, then you can provide bonuses and incentives to your team for profits above break-even. Because why would you provide any kind of bonus if you weren't profitable? Why would you provide any kind of incentive if the incentive wasn't driven by what it took to increase profitability? So we believe there's 2 elements in doing this correctly, and I'm going to tell a story or 2 about this. But the first thing is a lot of times small and mid-sized businesses do not do employee reviews. ProfitSee has actually built a way of doing weighted employee reviews. It's a 25-question piece, and you get points on it. 100 is perfect. Nobody would do that. You'd have to be able to walk on water. But the idea is I want to make sure I want to weight the employee reviews. And I'm only providing them to salaried or hourly employees only, not the commissions that go on the sales team or people that are incentivized already by increasing revenue. So those are the 2 things. And why do we want to do that? Because I might have a receptionist, Andre might be a receptionist, and he might be so golden, so incredible, that when people call the company, they're uplifted. He just makes them happy. Any of us that come in to the office, we see Andre, and Andre just makes us feel golden. And then there's Nicole, and Nicole is the controller, and she's like a black hole. You walk by, people avoid walking by Nicole's office, but Nicole is highly paid, and my receptionist is not. So in weighting it by reviews, Nicole might find out, even though she's more highly paid, because she is basically a negative influence on the culture of the company, that the receptionist would get a higher bonus than Nicole would. But I couldn't do that if I didn't have an employee review that said, here's why. These are the things I need you to change. These are the things to move ahead on. Now, I know business owners, they get busy because they're the ones that are doing XYZ to drive the company. But it's imperative that you have employee reviews and weight them in such a way that your salaried and hourly employees know that by doing certain things, it can actually increase their incentive. Now, the question I'm always asked is how much? So I had a business I worked with, oh, it must have been 15, 18 years ago, and they had been trapped at a certain production level. They were doing about 1.7 million a year and had been trapped there for like 10 years. And within the first year, I took them to 2.6 million. And I won't tell you how we did it, but one of the things we did do is we put these bonus and incentives in. But I will never forget the discussion that we had about creating the bonus. He said, how much should I give a profits above break even? I said, by your size company, 25%. He said, what? If I make 600,000 in bonus for me, I'm going to give them 125. I said, yeah. Oh, I don't want to do that. I said, okay. I said, do you have a quarter? He said, what? Do you have a quarter? Do you have 25 cents? He said, yeah. I said, give it to me. He says, are you going to give it back? I said, you don't need to know. Give me the quarter. So I give him he gives me the quarter, and I open up my wallet and I hand him back $1. He says, is that mine to keep? I said, yeah. Do you have a quarter? He said, what? I said, do you have another quarter? He said, yeah, give me the quarter. I give him the quarter. He gives me the quarter, and I hand him the $1 back. I said, how long are you willing to do this? He goes, oh, I get it. And then he goes, can I keep the $2? I said, yes, you can keep the $2. Okay, so the point is... That
does tell you something, doesn't it?
It really does tell you something, okay? So the point is, for a larger business, say with 30, 40 members of the team, the bonus and incentives might be 50%, they might be 60%. But the point is that people are motivated to make it happen. I have to tell one more story about this individual. Again, it was about 15 employees, and they were very happy. I mean, that's a nice revenue to labor ratio 15 years ago, 16 years ago. And so I was doing follow-up with them, and they were very, very excited because they were about to hand out the first bonuses. And the receptionist was a wonderful lady. She was 40, a single mom, 2 teenage girls, and had basically most of her adult life had worked at near minimum wage. But they had hired her, wonderful person, and I was there when she got her first bonus check. And he handed her the check, and she opened it up and she says, oh, you've given me somebody else's check. He says, what? Oh, and he looks at it, he says, no, this is yours, and he hands it back to her. Her bonus was $2,580. It was more cash than she had ever seen in her life in one place. And she starts crying. And he says, no, you're worth it, you're worth it, you're worth it. So it was very touching emotionally. But then I talked to him a month later, and he says, I have to tell you what happened. I said, okay. And they're kind of in the South in the United States, and it gets very warm and humid in the South. And so he says, I came into the office, and my office was closed, and the air conditioning was off, and the room was really steamy. So I went in, I put the thermostat on in my office, and then I did my walkabout, because he managed by walking about and visiting with the team, which was great. And when I got back to my office, the air conditioner was off. And he thought, this is strange. So he turned it back on. Then he went out to lunch, and he came back, and the air conditioner was off. So he went up, I'll call her Christine. He went up to Christine. He says, you know, Christine, every time I leave the office, my air conditioner is off. He says, what's going on? She says, oh, that's me. She says, it's you? He says, yeah, electricity costs money. That's eating into our incentives. So
that's brilliant.
Like I said, I don't have to make these stories up. They really are what happens with the team. So there is a right way to provide incentives to increase your profitability. But you can't know how to do it if you don't know the true break-even and you don't provide people the motivation for doing it. Now, this is another important part. A lot of studies have been done, human resources studies, on what are the things that most powerfully affect employees to have them be productive, efficient, contributing, and all this stuff. Well, the first thing is the quality of their life. So, you know, if they're on slave wages and they're underpaid and the culture of the company is not good, then they're not going to perform well. You might have a business or service that has such high margin and high demand, you can afford to do it, but you're cheating yourself. So quality of life and the culture is the most important thing for most people in a company. Right alongside of it is people want to be recognized for their effort and accomplishments. You know, it's kind of like, I hate to compare it to dog training, but for every rebuke you give a dog who is, you know, basically the ultimate expression of unconditional love, for every rebuke, you have to have 6 praises follow it. So it's important to tell your team, great job. You know, I really appreciate you working here. You know, you've been with us 3 years, and it's little things that cheerlead, but recognition of their effort and accomplishments is huge. And then the final thing is, because none of us are, you know, hermits, do they have acceptance on their teams? Is there a synergy within their teams? If that isn't there, then maybe move them to another team or figure out, you know, who the saboteur is. But you have to look at those things in terms of human resources. Now, notice that income and benefits and incentives are not in the top 3, but they are always in the top 5. So that if you can provide those 3 things and drive their incentives against profits above break even, you want to see your profitability triple, quadruple quickly, this to me is one of the most important numbers in the company, is how do you create a motivation for your team to increase those profits? And we've seen this work for 20 years. I've seen it work.
It's a really good, I know, you know, some of you came on the webinar and are thinking, well, I thought I was just going to get some financial numbers. Why are we talking about team and all this? And I think if that is the way that you're thinking, you may be in the story of the guy who wanted the quarters and wanted the dollars, because it's very small-minded to think that way. It just, I know so many business owners like that. And the amazing thing is they're lovely, nice, talented, excellent people. But when you ask them for a quarter, they look at you and go, am I going to get it back? And you're like, it's a quarter. You know, in the UK, that's worth even less. It's just, why are you thinking on it this way? So I just, you know, just a quick challenge to say, you know, make sure that when you're looking at the numbers, if you have team members, some of you attending may have your own business with no team yet, although I still encourage people to look at outsourcing or virtual assistants or any of that. But
right.
You know, that is such a critical element. Every successful business, every single one without fail, if they're doing well, they always point back to their team members and they treat them well and they give them the right kind of rewards. And so I do think this is really valuable. But sadly, we have to power on because we have 2 more to cover and we have about 5 minutes to do it in. So, but I did want to highlight that if you, and I think Peter would say the same, if you don't get that right, you can look at net profit margin till kingdom come, but you're still going to be missing something.
So at any rate, yeah, let's push on to the next slide. Really, what is net profit margin, okay? Well, it's the ratio of net profits to revenue, okay? So usually it's the net profit divided by the revenue, which is a margin. And this is where net profit is where revenue minus cost of goods minus operating expenses minus interest and taxes. So what happens when this becomes effective is that the profitability is represented through a percentage of what revenue is driven. And in order to do it, you absolutely need to know what your cost of goods are, your operating expenses, your interest, and your taxes. These are the things that your accountant is going to work with to help provide tax-advantaged opportunities for you. You know, may you pay no penny in taxes, and may the Queen not determine who you spend time with at a federal institution and who your roommate is, right? We have to pay taxes. But the idea is that you want to be able to identify what your net profit is. And if you have multiple products or services, which of them are the most profitable? So again, this is where really robust accounting software like Xero and tools like the ProfitSee tools that our accountants are using can help you really shade, oh my goodness, this product set, this service set has a 23% net profit, where this one only has 2%. And we spend 40% of our time on a 2% profitability and 60% of our time on a 28% profitability. Again,
Yeah.
it's simple numbers.
This one, I could, and that's why we have the surprised guy here, because I can't tell you how many surprised business owners I've met with who have looked at the hard and fast numbers that you can't argue with and suddenly realize they're spending 80% of their time on a product that is not bringing in as much, and it's horrifying. And
It is,
the
yeah,
only thing I will add is it is okay if you want to do that for a particular reason. If you do charitable work and you are pouring energy into something that's not making you a profit, but it gives you a feel-good factor and you love it and it makes your and other people's lives better, that is okay. But you have to know that and you have to accept that and communicate it to the team and all of this. But if it's a shocker to you and you wish it wasn't that way, you need to make some hard decisions and possibly have a few customers who aren't very happy, because you might have 3 customers that think this is the best product they've ever seen in their lives and 500 of them who don't care. Now you've got to come up with either a way to please the 3 or just say, all right, they're not going to be happy and that's just life and I'm going to pick what's profitable for me.
Absolutely. So again, I think this is a really important magic number, because not everything that you're offering and selling has as high a margin. Now, it could be that the thing that you're selling at a lower margin is the reason they're buying the things that have a higher margin. So it isn't, don't throw the baby out with the bathwater.
Yeah.
But it's really, really important to understand what is going on dynamically in each of your products and services. And now we're going to go to benchmarking. This is another interesting element here. What is benchmarking? Well, every industry has benchmarks, okay? And usually they're measured in a bell curve. And so you'll look at the performance numbers. It could be profitability, it could be revenue, but they look at the benchmarks and who do you want to measure yourself against, okay? Now, here's what I find interesting about benchmarks. For benchmarks to be statistically valid, there have to be a large enough sample of businesses in your industry sector. Now, the thing I don't like about benchmarks is it assumes that the middle is the, quote, average, the mean of what is going on. But what it doesn't address is whether those companies are functioning well or not at all well. But it's still a mean average, you know. So they look at costs, they look at sales per employee, they look at profit margin. You see this wonderful bell curve. This is why when Jack Welch was running General Electric, he said, any industry sector we're in, any one of these benchmark areas, we are going to be first or second. In other words, he wanted to be in the top 5% of what was going on. And actually, he really meant, if we're second, you better tell me why we're not first. But the reason he would say that is he understood that industry norms does not mean industry excellence. It just means where the mean of the entire industry sector operates. So the thing you always want to look at when you're benchmarking your operation is you want to be in the top 25% of performance. And you can do it because most business owners are busy being busy, or they're self-employed with helpers. They're not really proactively understanding the 4 key number factors that help drive their companies.
I couldn't agree more. And I just suddenly thought of something that was making me smile. I was attending a conference, and there was a guy speaking called Peter Shankman, and excellent marketing speaker. Love the guy. He's hilarious. And he's talking about customer service standards. And he said, the thing is, everybody thinks you have to be this phenomenal customer service, and you have to be awesome, and you have to kick ass and all this kind of stuff. And he said, yeah, okay, that's fine. He said, really, what it comes down to is you have to be 1 level above crap. And if that's where you're at, you will beat out so many others, because he said, just as Peter's saying, there's so many companies that are busy and tired and stressed, and they're not responding quickly. And people are so annoyed when things are not done well that if you just do a fine job, you will beat out a lot of the competition. Now, granted, if you want to hit the top, you need to be awesome and you need to be legendary.
Right.
But so many times you can take business from other companies by simply being one level above crap, which I thought was very telling and very true. And you know, it's as a target to shoot for, it sounds like a fail, but I tell you, you can really get a lot from it. So,
you know, Karen, one of the questions I like to ask, I'm going to ask you this: have you ever had a bad shopping or business services experience in your life?
Oh yes, many.
How long do you remember them for?
I could probably go back 20 years at least. Matter of fact, I can remember one. I guarantee you it was at least 20 years ago. I remember the company. I remember how annoyed they made me feel. I remember how many people I told about it. And the really funny thing was, this happened before I moved to the United Kingdom from America. And I joked that I was fleeing the country to get away from this company who was chasing me for $300 that I didn't owe them.
Yes.
And
Okay.
they would not give up. It was horrendous.
So here's the point behind your answer. A bad experience people remember forever. And if you want to know how many people they tell about it, just figure out at a given funeral how many people show up at the funeral, because that's how many people that person in the crate told about how horrid the experience was. And so this is why benchmarking is tricky. You don't want to be in the norm. You have to be just one unit above the norm. Don't create bad experiences. It will put you in the top 25%. That's where you want to be.
Absolutely. And that is the amazing thing, is you can do all the amazing things in the world, but people expect you to be good. But if you hit a really bad level, there is a now, that being said, if you fix it immediately and quickly and friendly and cheerfully, you may be able to save it. But we all, and I know Peter knew this when he was asking, is that every single person and all of you listening, you all have horror stories, and we love to share them. I absolutely love sharing horror stories, because you're like, yeah, me too. But you know, people do like to share the happy stories as well, because you know that made their life better. But
I know we're running out of time. I want to tell one real quick story.
Sure.
In our early years, first couple of years, in order for us to capture data, because Xero wasn't far enough along and we weren't a partner with them, we were using the Intuit accounting back in the early years. Their technology was so kludgy that we had to literally create a way to capture it. My own programmers did, so it could be used through accountancy. And we had someone who had just a horrid experience with it. And we felt so terrible. And they were in the UK. So what did we do? I called them up and personally apologized. My marketing director, Brooke Roberts, researched high-level restaurants. We fixed the technology problem, and I sent him a £100 gift card to go out to dinner at the restaurant. And I knew we had to do that, because I did not want 50 other businesses hearing about a bad experience. It was my job to make sure that the experience with our clients was absolutely spectacular. And that's really what benchmarking is about.
That's a great point. And I could probably tell many similar stories. I've done the same thing, Peter, and just thinking about treating somebody in a way that you would want to be treated if you were the customer. Absolutely. And they will give you a lot of grace if they feel like you care. I think the thing that frustrates all of us as customers or clients is when not only are we not getting an answer, but we also feel like they could care less that we are their client. So I've had clients that I've said, listen, we are fixing this, we are behind this, we are sorting it out, but it's going to take a week. And suddenly the person who wanted it fixed yesterday says, oh, okay, that's totally fine, thank you so much. Exactly. Because they can see that we're trying and they can see that we're making an effort. And then when it is fixed in 3 days instead of a week, they suddenly think we're the best people ever, because it was going to take a week, and it only took 3 days. So,
Absolutely.
the under promise, over deliver.
Absolutely.
But yeah, we're going to have to sum up because Peter and I could tell stories all day long, and we love to. But if you have any questions, type them in, and we will get an answer to you. But just as a quick summary, talk to your accountant about these 4 things if you don't know them. Particularly look at this break-even and the true break-even that Peter talked about. If you want a copy of the slides or anything you want to look at that, then just ask your accountant. They'll get them to you. But I think that's a really critical element to look at for your business. And if you can look at these 4 and the true break-even, you'll be going a long way.
Karen, this was
So
a delight.
Peter.
Thanks for inviting me into the presentation today.
It was my pleasure to have you, and I'm sure it was everybody's pleasure to listen in. We really appreciate it, Peter, and thank you all for your time.